The most reliable correlation since 1995 has been yields up, dollar up. And so when you see US yields are going up and the dollar selling off at the same time, that's a capital flight story, which is a little bit scary, I would say.
Regime change is here. That's what Brent Donnelly of Spectra Markets wrote to his clients this week. Brent joins us this week to talk about the US dollar, interest rates, the equity markets, and more. I'm Ed D'Agostino, and this is Global Macro Update. Brent, it's good to have you. You wrote a piece recently called Kiss of Death, and you start out by saying that regime change is here. And that always gets my attention when I feel and then start to see people talking about a regime change. First, let's just start out with the basics. What do you mean by a regime change? And then let's get into what's triggering it.
The big regime change going on right now is that generally when US yields go up, the dollar appreciates. So people are generally in developed markets are attracted to currencies that have higher yields. So if yields are going up in the US, usually that means that growth is solid, inflation is solid, nominal growth is good, and the Fed is, on hold or hiking. And so generally that means that people will be attracted to the dollar. And then in contrast, what you usually see in emerging markets is that if people are worried about the credit or the deficits of an emerging market country, then they'll sell the currency and sell the bonds. So the yields in emerging markets will go up, but the currency will go down. And generally that's a thing for emerging markets, but that's what's been going on in the US lately. And I started in 1995. And one of the most reliable correlations, because I'm more of a short-term trader that looks at the macro picture and then tries to zoom in. The most reliable correlation since 1995 has been yields up, dollar up, or yields down, dollar down. And so when you see the bond market is selling off, so US yields are going up and the dollar selling off at the same time, that's a capital flight story, which is, I don't want to overstate it because we're, two weeks into this regime change. But it's a little bit scary, I would say, because what you really want when people are worried about growth is the release valve should be that bond yields go down, and that eases financial conditions. But what we're seeing now, because of the policy mix and the amount of uncertainty around the policy, is that people are just like, you know what, get me out of anything that's US and put me in something else. So buy Bunds, buy German equities or whatever. And it's been very, very concentrated in Asia time and Europe time. So as soon as Asia comes in, the dollar just sells off like every single day. It's wild to see. And then if you zoom out a little bit, it's very similar to like 01, 02, 03, when we had the dot-com bubble and all the money came into the US. And there was kind of no alternative really at that time. You had a free lunch buying the dot-com stocks and you got an appreciating dollar. So as a foreign investor, you got a free lunch. And then when dot-com popped, everyone wanted to get out. And then everyone kind of looked and said, oh, the dollar's very overvalued here. I don't like tech stocks. And look at those twin deficits. That's what they were calling it back in those days, the budget and the trade deficits. So then essentially from that point, which was like 2002 to 2008, you had like a 6-year dollar bear market as the market had piled into US assets and then for 5 years and then piled out for 6 years. And it's very similar now, right? So you had the Mag 7, there was an acronym TINA, which was there is no alternative, right, to the US. And really people just felt stupid buying anything that wasn't US because it outperformed for so many years. So it's very symmetric compared to the dot-com burst. And then pretty much from the day DeepSeek came out, people have been worried about AI CapEx valuations. And then on April 2nd, you got the policy announcements, which have been kind of devastating for the foreigners' view of US policy. And so that has triggered kind of a double whammy now where people are looking at what's going on with policy. We own all these potentially overvalued Mag 7 stocks, and we don't really know what the trajectory of tax or tariff or economic policy is. So let's just get out and, shoot first, ask questions later. And all of that's coming from a very, very bubbly starting point because the initial reaction, as you know, to the election was everyone was like, okay, another another big, huge leg higher in U.S. exceptionalism is coming. But unfortunately, that hasn't been the case, like I said, with the policy stuff. And then kind of humming in the background, there was this idea that Scott Bessent would reduce the deficit using, Doge and Elon Musk's attempts and all that stuff. And then as that's been downgraded, so Musk had said 2 trillion, which was mathematically impossible unless you cut Medicare and defense. And then they said, oh, maybe 1 trillion, maybe 500 billion, maybe actually 150 billion. So those cuts are essentially zero if you count like potential IRS collection issues and all that. I mean, it's going to be a rounding error essentially. But then at the same time, slower economic growth, if it comes, is bad for deficits. So when you thought we were going to get a deficit reduction story, we're actually going to probably see 7% deficits again. So deficits are getting worse, which is one more reason why people are getting out of U.S. bonds. So it's really a perfect storm. And everything I'm describing has happened in the last 2 months. So really the question is then going forward, does it continue or is this just like a panic?
How much do you think of the, like I've got 1,000 questions after after that, but how much do you think is simply uncertainty that could be temporary? In other words, if there was better communication of policy change, which I think is sorely needed personally.
I would agree.
There was better communication. Could some of this uncertainty go away? And would that ease markets long term? Or do you think that there's been permanent damage done?
I'm more in the second camp. There's this concept of hysteresis, which is basically like scarring. Once an action has been taken, you can remove the action, but then there's still going to be some damage from it. And I think the biggest damage is that trust has kind of been broken. So like the whole China thing is a whole separate issue, which has been going on for years, right? It happened in the Trump one and then Biden continued the tariffs. So if you just forget about that, but then you think about like the allies of the US, at least on paper, I know some people would disagree with that, but on paper, I think most people would have considered Canada and Europe to be allies of the United States, having fought in world wars together and so on. So the fact that now there were tariffs on Canada when the USMCA was an agreement that Trump had already signed, and then he tariffed USMCA goods, then took the tariffs off, then put them on certain sectors, kind of shows like a bad faith element to the whole process. So the ability for the administration to then sign 70 trade deals in short order just seems super unrealistic to me. I mean, the average trade deal takes about 18 months to sign. And I mean, some of them are like 35, 40 months. These things are like 1,000 to 2,000 pages long. They're talking about specific tariffs and exemptions for bananas that come through another country. It's so complicated. So I don't think you can really get the genie back in the bottle. You can make it less bad, but I don't think you can you can't return to U.S. exceptionalism by just simply saying like, okay, forget it, and also I don't expect that to happen. But you can make things less bad. The fundamental issue with trying to like repair this is that you're already starting from a point of overvaluation in the U.S. dollar and probably in Mag 7 as well. So even if we go back to some more understandable policies, I think the damage is kind of done. And then if people are focused on deficits, which is, I think, where the focus is going to go, and that's why people are selling bonds and selling dollars, that just also is almost like an intractable problem. Generally, throughout U.S. history, deficits are a way to stop recessions, and generally, deficits increase in recession and they decrease in boom times. And then in 2017, the Tax Cut and Jobs Act was the first time really that the U.S. did massive stimulus at the peak of the cycle. And so the link between deficit, the Keynesian theory of how to run the economy, was broken. And then Biden doubled down on it, with another 5 trillion or something after COVID. And some of it probably was justified, some wasn't, but whatever. And so now it's just like nobody ever says like, how are we going to pay for this? They say it as like a sideline because there's some conservatives that are still believers in fiscal responsibility. But essentially, if you look at what they're actually doing, I mean, the deficit's just getting bigger. And then, so I think this will be a protracted theme that probably goes on for a couple of years. And like, I'm not a big, it's going to turn into a huge crisis kind of guy. Like the dollar dropped 50% from 2001 to 2008. And none of the crises, like we had 9/11 and 2008, the dollar really had nothing to do with those. Those were just things that were going on and completely separate from the dollar. So I don't really think that the dollar going down necessarily means that there has to be some massive collapse in U.S. hegemony or anything like that. But I think it's a challenge because if people don't want U.S. bonds, then ultimately probably you're going to be forced to just get the government to buy them at some point. Like that's the ultimate end game is yields go up too much and then there's so many different tricks they can pull, like buying forwards in the forward market in order to narrow swap spreads is an easy one. They can change the rules for banks to allow banks to own more through SLR changes, like bank regulation changes. And then eventually the Fed can just, target yields. I mean, that's like what happened in World War II or whatever. So there's really like this idea that the bond market will collapse and all the wheels will fall off and, some kind of dystopian fiction finance thriller will unveil itself in front of us. I'm not a big buyer of that because ultimately the government has a lot of tools to intervene. I mean, you saw it in the UK, which is a way smaller market in 2022. And it was a very similar thing. The currency was selling off and the bond market was selling off. And the Bank of England, who was actually in the process of reducing their balance sheet, simply came in and said, we're going to buy unlimited amounts of bonds. And no speculator, even named Soros or Elon Musk or whoever can take that on because they can literally buy infinite bonds at some point. So to me, it's more of like another cyclical adjustment, the exact same one that we saw from, up in 95 to 01, down 01 to 08, and then essentially kind of flat for a while, then up on the Mag 7 AI story. And now I think we're going back down. So that's how I see it, is more like a natural cyclical thing. Whereas if you look at the external value of the dollar, it actually hasn't changed much in the last 30 years. It just goes up a lot and down a lot.
How do you feel about the direction of trade deficits and the impact? Do you think that our trade deficit goes down?
I don't really think so, honestly. I don't think that there's enough capacity to create a huge manufacturing boom in the U.S. Just simply because so much of the economy is based on services now. And I think that's really what's missing in this whole policy move, is that there's so many other parts of a balance sheet and the way that things balance out is that the U.S. net investment position and all the money flowing in is kind of like an offset, essentially, right? So I'm not a huge believer. I mean, at the margin, sure. I mean, some manufacturers will definitely come to the U.S., but a lot of manufacturers are also probably about to go bankrupt because they can't source parts for their own manufacturing business, in 2025. So I could see the logic of like there is a benefit maybe further out, but the pain will be real in the short term. And the short term could be 2 or 3 years, I think.
Yeah. So your point about deficits and then investment is, I think, important. I was lucky enough to speak with Lizanne Saunders from Charles Schwab earlier this week, and she said that same thing, that people sort of don't realize that a big trade deficit means a lot of U.S. dollars are getting put out into the world, and the holders of those dollars want to put those dollars to work, and so a lot of it just comes back and is invested in our bond market and in our equity markets.
Right, exactly. And that has a benefit. I mean, you can definitely argue that there are many negative externalities to that, like overvaluation of assets and also over financialization of the United States, and hollowing out of the middle class. So like, I wouldn't sit here and say like all this stuff is crazy. The issue is that the execution has been so bad that no one believes anything that is said now, because you have 4 different people with 4 different theories. That's the thing too, is that any sort of orthodox economist will point to Smoot-Hawley and to history and say that tariffs are generally bad and mercantilism doesn't work. However, at the same time, you can still make some argument that it's gone way too far the other way. I think that's also an easy argument to make, that the United States has been hurt by going way too far in a world where many countries are unfairly tariffing and the U.S. is not. So, but to just announce stuff every single day that's different from the day before, using 4 different mouthpieces who all disagree on the fundamental reasoning of whether it's to rebalance trade or to raise revenue or to punish China or to create a coalition of the good against China. So with 4 people having 4 theories and then different announcements every day, it's way too chaotic and unprofessional.
It's really hard to invest right now.
Right. And so the thing is, if you don't know what to do in any situation, you freeze, right? You just wait and go, okay, I don't have enough information to know whether I can set up a company here. If your company is forced to shut down, it's forced to shut down. But as an entrepreneur or a businessman, you're not, or a business person, you're not going to sit there and say, oh, you know what? I think I'm going to open a factory in Ohio because of this tariff policy. Like the tariff policy might be different in 3 weeks. So I guess that's the most troubling part of it, is just the amount of uncertainty for no reason really, because there's obviously a lot of support for the broader strokes of the policy from the electorate. 77 million people voted for something that looks roughly like this. But it's just become such a hodgepodge that, especially as foreign investors, it's almost like now you have career risk if you're overweight the US, because you say you're a Canadian pension fund and you're like the CIO, and then you obviously have a boss and a board of directors. That boss and board of directors is going to be looking at you when your June statements come out. And if you're overweight US, they're going to kind of go like, have you not been reading the news, dude? Like, this isn't a good situation. And also the US is trying to annex us, by the way. So we also probably shouldn't be overweight the country that's, threatening to annex our country. So there's a political element to it as well from like European and Canadian pension funds. And that's why they're selling, is partly politics. But then there's an economic reasoning, which is, hey, this stuff all had a great run for 5-7 years. We made a ton of money. We're massively overweight because we made so much money. So let's just take some chips off the table. I think that's the real rational argument of what's going on.
So all of this sounds pretty negative for U.S. equity markets. Do you think that, we have an equity market that is market weighted, S&P 500 is market or weighted to individual stocks, and the Mag 7 have this disproportionate weight. Do you think that those stocks suffer more, or does the entire index suffer? Is there rotation happening underneath the covers? What do you think? What do you think plays out in the equity market?
I think those stocks definitely suffer more because that's where the biggest overweights are. And not to get into the weeds too much, but if some pension funds don't actively rebalance, so if you buy something at 10 and then it goes to 100, it's just by definition going to be a way bigger part of your portfolio than some piece of crap Europe thing that you bought that didn't go up. So there's just a lot of overweights in the things that went up the most, and which is Mag 7. And so I think also people generally, if you're running any kind of more conservative strategy that's trying to get out of the US, that's the first thing you're going to get out of, especially with DeepSeek and NVIDIA. And then, there's still this awareness that CapEx cycles are not infinite, right? Like whatever cycle you want to look at, the commodity super cycle or .com, eventually people have enough of whatever that thing is that you're trying to build. And then it becomes a productivity enhancer and a great thing for society. But the people building that thing eventually don't have any more customers because, once you laid all the optical fiber in 2000 or dug all the mines in 2013 for the copper and the iron ore, there's no then need to dig more mines. They're all dug. And so I think people are worried that we're getting to that point with the chip story and CapEx as well. So that's another reason why I think those sectors will suffer more. And also the other fundamental thing is that in this kind of world, like where you're buying Europe and selling US, you're essentially buying value and selling growth by definition, that's what you're doing because Europe's cheap and the US is expensive. So as you go down the ladder, you're always going to start by selling the most kind of highly valued things. So I'm bearish equities, but I actually wrote a piece today. So I'm a big fan of looking at the alternative hypothesis because it's so easy to get set into it's so easy to get set into okay, recession's obvious, sudden stop in hiring and investment. Obviously, there's going to be a stagflationary recession, prices are going up. And I think that is the base case, honestly. But it's also pretty well known at this point, right? So I'm trying to think of what are the off ramps or what are the better scenarios. And honestly, I don't have a good answer to that, but I'm always going to be open to the fact that economists can be wrong. They thought QE was going to cause a lot of inflation. They thought Silvergate was going to cause a banking crisis, et cetera, et cetera.
Mm-hmm. So, transitory.
Right. Inflation was transitory. So sometimes things that seem obvious to the orthodox world of economics end up just being completely wrong. So I guess the way that it plays out in a bullish fashion would be that people are kind of frozen right now, but then they just kind of go, well, you know what? Manufacturing is a small part of the economy. Services are still okay. Consumer keeps spending. There's a lot of supply chain issues, but people find alternate suppliers, and all of a sudden in 2027, we're at new all-time highs. So I think that's a scenario that's worth considering. But honestly, I think it reminds me more of two different times. So there's one time in 2007 when Bear Stearns went under, and then we rallied, and it kind of seemed obvious that things were not good, but we just kind of hung around because no one was really sure. And you can only take stocks down so much without a recession, right? Once you get down 15, 20%, it just becomes harder for stocks to go down. And that's kind of where we got to. But then, the shit hit the fan and stocks went down another 30%. And it was kind of like that in February 2020 as well, where it was businesses were starting to shut down. Things looked really bad. And I think NASDAQ made a new all-time high on February 20th, 2020. And obviously I'm saying this a little bit in hindsight, but I'm not really saying it in hindsight because even at the time, a lot of people, including me, were going how are we making new all-time highs? People are freaking dying everywhere and stores are closing and restaurants can't be open. And so sometimes the obvious base case just ends up happening. And the real key is going to be the hard economic data. So we've had 55 bad sentiment numbers in a row from every country. We get the idea that people are concerned and that sentiment is bad. But the real question is does that translate to job losses and hiring freezes and all that kind of stuff? And my guess would be yes, that it will. And I think the next 3 months really will be critical because even when Doge started, there was kind of this feeling, the whole Washington ecosystem is a pretty big employer. So not only are they cutting, actual jobs, but contractors and all the stuff that works around DC is going to probably start to cause unemployment. And you see a tick up in initial claims in the DC area, but really there's been no broad impact. Similar to the way the VC scare in 2023, you saw a lot of technology job losses, but the rest of the economy just picked up the slack. So I guess the question is in the next 3 months of data, do we see job losses and slowing growth? And it's very difficult too, because before that, we're actually seeing a ramp in the economic data because people are trying to buy cars and durable goods.
Front running tariffs.
Yeah, before the tariffs come out. So it's strange because you could have a business that's literally going to be bankrupt in 4 months or in 3 months that's at selling record volumes today because people are trying to buy your product before the tariff comes. But then once the tariff on China happens, your product is uneconomical and you're bankrupt. So it's this kind of a weird bullwhip where you're going to see strong data for a bit. And then if it falls off a cliff, which I think is the base case, then stocks could go down another 20, 25%, I think.
Let me jump in with a quick reminder that the Malded Economics Strategic Investment Conference is coming up, and you should join us. It's online only, live, with every conversation recorded along with transcripts. We start on May 12th. I'll be your humble co-host along with John Malden, and I hope you will join us. You can go to SIC2025.com to learn more. You said earlier that you're a short-term trader.
That's right.
And I so appreciate you saying that at the beginning of an interview, just because in general, there's a lot of people out there that watch these financial interviews, whether it be my show or seeing you on several other appearances and platforms. That's one of the biggest things that doesn't get talked about is just time frame.
Right.
Time frame.
It's huge.
And then,
yeah,
it really is huge. I was watching you and Jared Dillian, my good friend Jared, who introduced us, on the same show, and you were, one of you was bullish and one was bearish. And then, it turns out you're actually very much in sync with each other's thinking, but you were just talking about different time frames.
Right. Absolutely. I think that's very, very important. So like, if you're a buy and hold investor, then, that's your time horizon. You don't really have to spend a lot of time thinking about that. But if you're anything other than that, and I mean, even as buy and hold, you still have to think of like, okay, what's my terminal date? And like, how much risk do I want to have when I'm 52 years old versus when I was 30 and stuff like that.
And rebalancing, like when do I rebalance? How often?
Right. But so the way that I look at things is essentially I'm trying to like see the whole world from a macro point of view. And I'm looking at a lot at narrative, like the difference between the narrative and the reality, and are there any gaps where I think the narrative is overcooked or wrong or whatever. So I'm trying to see like, okay, the aggregate of all the information creates the current equilibrium in the market, which is where we're at. And then what are the most important things that could push us out of equilibrium? And then when we get out of equilibrium, did we go too far, too fast? And, like, is it greed and fear, or is it actual economic catastrophe and that kind of thing? So generally what I'll do though, is even though I'm more short term, I'll have a core view, which like now I'm bearish equities, but I'll also have a trigger. So if cash S&P is above 5,500, then I'm just like, okay, I'm probably missing something here. So it's essentially like a stop loss, but it doesn't mean that I'm always short S&P futures every single day. But it's kind of, my lean will be to be bearish. But, if I see something, opportunity or headline, I'll still be long some days. But generally my core view is S&P below 5,500. I want to be bearish because I want to sell rallies. The interesting thing is in this market has been, normally the convexity is it goes down fast and up slow. Like that's how stocks usually work. But actually it's been the opposite because people see this tsunami of bad economic stuff coming. So people want to be running underweight or short, but then you get your face ripped off if there's a Trump headline. So then, we had stocks up 12%, NASDAQ up 12% the other day. But we're not getting down 12% days. It's, down 3, down 3, down 3, up 12 kind of thing. So that's a strange dynamic because usually you don't go down slower and up faster. But anyways, all that to say, my view is bearish. That's my cut. And then really what I'll be watching is earnings. Like I think the UAL earnings was really interesting where they, instead of making a forecast, which is I think very smart, they had a bimodal forecast. So they said, if policy doesn't change, this is our forecast, which is recession and $7 a share. And if things are, dialed back, then business as usual, $12 a share or something like that. So watching earnings, but then most importantly, just watching the hard data. So claims, you can't really watch retail sales because of the front running. So it's mostly the jobs numbers, I think, that are the most important: claims, non-farm payrolls, unemployment rate. Because when we kind of got scared there in 22 and 23 about like, oh, maybe there'll be a recession, consumers just had so much money that whatever was going on, even if people lost their jobs, they could find another job right away because the shortage of labor from 2021 kind of made its way through all the way to 23. So even if you saw firings, those people just got jobs right away. I don't think it's going to be like that this time. I think people have generally, the excess savings have gone down. And so if people are losing their jobs now, which I think they will, then it's not going to be as easy to find a job. So I think in the next few months, we'll see the labor market look worse. And I'm sure many of your viewers have seen this chart, but essentially if you just look at any time stocks have dropped a lot, like say 10 or 15%, and then you use that as your starting point, say 15%, and then, which doesn't happen that often. So you have like whatever, 15 lines, then what happened after. All the no recession lines go up and all the recession lines go down. So it's very binary. Like you have to make the call as an investor. What are the odds do I attach to a recession? To me, the odds are high. And I think it will be probably like not that deep of a recession, but a very painful one because prices will be still going up. And so to me, that's my base case, and that's going to be bad for equities.
Earnings, a lot of companies pulling back on their projections, which is pretty concerning.
Yeah, that's the visibility thing, right? Is that not necessarily like you don't say, okay, we thought we are going to make $1.85, now we're going to make $1.30. You just say, I thought we were going to make $1.85, and now I got no clue. So
no, I don't know.
I'll just shrug or put my hands in the air. And one thing that'll be interesting, just thinking this will come out on Friday, so yes, this will still be relevant. Next week, you get some of the tech earnings, and I think so. One issue with like all data and earnings right now is they're all backward looking. They're all things that happened before April 2nd, right? And all we care about is what do things look like after April 2nd? But one thing that will be interesting from those earnings reports will be the AI CapEx spending plans, because that obviously is forward looking. And if people are scared, if you're at Meta and you see like ad revenues have dropped 20% because Shine and Temu and all the Chinese companies stopped advertising, and Big Pharma's pulling back because they don't know where that's going. So maybe they're pulling back on advertising. So if Meta is seeing that, then they might reduce their CapEx. And so interestingly, I think there'll actually be a read through from like Meta to NVIDIA, for example, because NVIDIA being the big CapEx play, if CapEx has peaked, so essentially you can put a marker as like the day DeepSeek was it was announced, but the day the market realized DeepSeek was a thing is essentially like that might be peak CapEx, because after that you got Microsoft canceling orders and all that with CoreWeave and all that. So if now the actual CapEx numbers do start to come down, I think that's going to be very bad for semis, because in the end, usually semis are cyclical. And I mean, is NVIDIA a semiconductor company? Yeah, basically.
It is, yeah.
I mean, it's chips,
at the end of the day,
whatever.
Yes, it is.
Yeah.
I want to ask you what your favorite safe haven is to end this. But before we get to that, tell me and tell the viewers how they can follow you, learn more about your daily work.
I have a couple of books, Alpha Trader and The Art of Currency Trading. And then my website is spectramarkets.com. So everything's there. The main thing that I do is a daily macro letter, and then I cover hedge funds for currency trading. So it's Spectra with an A at the end, markets.com. What was your question right before that?
Yeah. So my question is, if you're
safe havens.
if you're a certain
Right.
if you're of a certain age, right, or if you just if you're conservative or you're concerned about all the things we just talked about, right, where do you hide? What's a safe haven?
It's an incredibly pertinent question, because normally the safe haven would be U.S. Treasuries, right? But if people are a little bit worried, or more than a little bit worried about the credit risk, or it's not even really the credit risk, it's more policy risk. Of course, the money will get paid back, but how deflated will that money be is essentially the question. So if U.S. Treasuries are not working as a safe haven, which they definitely are not, and the dollar is not a safe haven, which it sometimes used to be, but is not now, then you have to look, obviously gold has been a lot of the safe haven money has been going there. The Swiss franc generally, I think, is good, but you're fighting the central bank there. So I would say, honestly, buying euros is a pretty good safe haven now. I think for the next few years, buying like German debt, Schatz, or buying straight up just buying euros, I think is actually going to be a pretty decent place to put your money. And I'm kind of all over the place on Bitcoin, but I will say through this episode, Bitcoin has performed very well. Even when gold's selling off or when the dollar's rallying or whatever, Bitcoin's actually held in pretty well. So, I think if I was looking for safe havens, I'd be like 50% cash, 40% euros, and 10% Bitcoin or something like that. But the Bitcoin thing is very, a lot of people would say Bitcoin's a risky asset. So that's more of like it might work as a safe haven and definitely not investment advice.
Yeah, no, I get it. And just the fact that you're advocating euros, just thinking about a year or two ago, like no one would have said.
Well, it's absurd how things change, and sometimes people will say that, like, well, 6 weeks ago, U.S. exceptionalism was the theme, and I mean that's true that things do change, but actually the facts have changed a lot. And when there's a regime change, a lot of times these regimes are almost structural, like they run for like 3, 5, 7 years. So, you would have been great buying euros in 2001, and I think you'll be great buying them again.
Brent, this was a fun conversation. Thank you so much for your time.
You're welcome. Thanks for having me.